Understanding the standard deduction. That is what we're going to be discussing in this lesson. This is probably going to be one of my favorite lessons because I love the impact that the standard deduction has on my tax liability. So let's dig in. First, the standard deduction is a fixed dollar amount that reduces your taxable income. And depending on your filing status, it can have a substantial impact on the amount of income that you have that is subject to tax. So it's a standard deduction. It's available to all taxpayers, and it's based on the filing status that you choose. So for instance, if we choose the single filing status, the standard deduction is $13,850. If we use the married filing jointly filing status, the standard deduction is $27,700. If you choose head of household, it is $20,800. If you choose married filing separately, it is going to be $13,850. And if you use qualifying surviving spouse, it's going to be $27,700. Now we're going to go ahead and talk about why these are the same and why these two over here are the same. So single and married filing separately are both the same amount. Married filing jointly and qualifying surviving spouse are the same amount. And we'll talk about that in just a moment. But first, let's talk about the impact. So let's say you made $50,000 for the year. If you are single and you are reducing this by the $13,850, that would leave you $36,150 that you'd pay taxes on. So no one wants to pay taxes on their full amount, $50,000. So the standard deduction is huge because it takes that amount as a standard deduction off of your gross income and leaves you with taxable income. So that's good. Now, why is selecting the right filing status important? Well, let's say that you made the same $50,000, but instead of being single, you qualify as head of household. So now you're able to take $20,800 off of this, leaving you with $29,200. So on the $50,000 income, would you rather pay taxes on $50,000, $36,000, or $29,000? I think we will all agree that we'd prefer to pay it on the $29,000. So that is why selecting the right filing status can have a huge impact on your overall tax return. Now, to recap, the standard deduction can have multiple impacts. One, reduce your taxable income. So by claiming the standard deduction, you lower your taxable income, potentially moving into a lower tax bracket. Number two, simplified filing. You can either do the standard deduction or you can itemize your deductions. But the thing is, if you're going to, for instance, if you're married filing jointly and you have a standard deduction of $27,700, for you to itemize, your itemized deduction would have to be more than the $27,700 for it to even take effect. So if your itemized deductions aren't even going to come close to that amount, it's just simpler to take the standard deduction. And for most people, they will take the standard deduction unless you have a lot of deductions. So those itemized deductions would go on Schedule A, and we can talk about that a little bit later. But standard deduction it's just simplified, makes it super easy. The other thing too is a higher standard deduction means less income subject to taxation and potentially resulting in a higher refund or lower taxes owed. So this section, again, one of my favorite sections, really important to understand. If you don't quite get it yet, feel free to stop, go ahead and rewind and listen to this over and over until you feel comfortable, because understanding this is going to be important to moving on to the other lessons. All right, so there are just a couple additional items that I would like to add to this lesson. Number one is I mentioned that if you are over the age of 65 or you are blind, there is an additional standard deduction that you may be eligible for. That dollar amount as of 2023 is about $1,850 that you can add in addition. Now, keep in mind, these dollar amounts change from year to year, so definitely want to stay informed. Now, if you are blind and over 65, then that amount is doubled. So you get $1,850 for each. Also, I mentioned in a previous lesson that if you are able to be claimed as a dependent, then you would get a lower standard deduction. That number is actually $1,250 would be the standard deduction if you're able to be claimed as a dependent on somebody else's tax return, or it would be your earned income plus 400. But keep in mind that earned income plus 400 cannot exceed the original amount for standard deduction. So if you are single, that standard deduction is $13,850. That earned income plus 400 cannot exceed that $13,850. So whether you want to take the standard deduction or you want to itemize your deduction, it all depends on which one is going to give you the highest dollar amount that you can deduct from your gross income. That is the name of the game, is how can we use credits, expenses, adjustments that we qualify for to lower our overall tax liability. That'll do it for this section, and I'll see you in the next one.